Most people think money is cash, a paycheck that disappears every month. But money isn't the goal. Money is stored time. Every dollar you earn represents hours of your life you will never get back. And when you waste money, you're not wasting paper, you're wasting life. Here's what makes this uncomfortable. Most money today isn't even real. It's not printed. It's not stored in vaults. It's created digitally through loans. When a bank gives someone a loan, it doesn't hand over existing money. It creates new money with a keystroke. That means almost every dollar in circulation exists because someone went into debt. Debt isn't a flaw in the system. Debt is the system. That's why debt controls behavior. Mortgages lock people into decades of payments. Credit cards keep people chasing balances. Student loans delay freedom before adulthood even begins. This isn't accidental. Debt keeps the machine running. Banks sit at the center of this machine. Most people think banks store money. They don't. They use it. When you deposit money, the bank lends it out. Again and again. Your deposit becomes someone else's loan. That loan becomes someone else's deposit. That's how the system grows. And that's why it collapses when confidence disappears. And here's the part nobody likes to hear. Banks pay you almost nothing to use your money, then charge others much more to borrow it. That difference is how banks make billions. Perfectly legal, perfectly normal, and completely misunderstood. Interest is the engine behind everything. It's either working for you or against you. There is no neutral position. If you owe interest, it drains you quietly, month after month. If you earn interest, it builds you quietly, year after year. The math doesn't care how you feel. Credit cards prove this perfectly. High interest doesn't punish irresponsibility. It monetizes it. Minimum payments make debt feel manageable, while compound interest quietly stacks against you. On the other side, compound growth rewards patience. It doesn't feel powerful at first. It feels slow, boring, almost pointless. That's why most people quit. But compounding doesn't rush. It waits. And when the curve turns, it turns violently in your favor. Now add inflation. Inflation is the invisible tax nobody votes for. Even low inflation compounds. If your money sits still, it's shrinking. That's why saving alone isn't safety, it's exposure. Holding cash feels comfortable. But comfort is expensive. The system doesn't reward stillness, it rewards movement. Then come taxes. Taxes aren't just payments, they're signals. Earned income is taxed first. Investment income is treated differently. Ownership is rewarded. This isn't corruption, it's policy. People who complain about taxes usually aren't paying too much. They're planning too little. And then there's credit. Credit scores aren't about morality, they're about predictability. Lenders don't care if you're a good person, they care if you're a reliable payer. Avoiding credit completely doesn't protect you, it weakens you. The system rewards control, not fear. Here's the real truth. None of this was taught to you on purpose. School trained you to be punctual, compliant, productive, not financially independent, not system literate. Because financial education creates autonomy, and autonomy doesn't fit neatly into systems of control. So people blame themselves. They feel shame. They stay stuck. But money doesn't follow emotions. It follows rules. Once you understand those rules, money stops being scary. It stops being mysterious. And this is only the beginning. Most people think investing is complicated, that you need a finance degree, a Wall Street job, or insider secrets. That's the lie. Investing isn't hard because the math is complex. It's hard because it forces you to think long-term in a world addicted to instant results. Here's the biggest myth, that not investing is the safe option. Holding cash feels responsible. But over time, cash is one of the riskiest positions you can take, because inflation never sleeps. You're not standing still. You're moving backward. That's why wealthy people don't ask, how do I save money? They ask, how do I deploy money? Saving protects you from emergencies. Investing protects you from the future. Most people confuse investing with gambling. Gambling chases excitement, timing, luck. Investing buys assets that produce value over time. One is emotional, the other is mathematical. Take the stock market. Volatility isn't risk. Permanent loss is. When you buy a stock, you're not buying a chart, you're buying ownership in a real business. Markets panic, headlines scream, but strong businesses keep producing value. That's why time matters more than timing. No one consistently times the market, but time in the market allows compounding to work. Compounding feels weak at first, invisible. That's why people quit. But over decades, average contributions turn into extraordinary outcomes. Starting early beats being smart. Time is the multiplier nobody can buy back. Now real estate. Real estate isn't magic, it's leverage. You use borrowed money to buy a productive asset. Tenants help pay the loan. Time helps appreciation, but it's not passive. It rewards preparation and punishes ignorance. Businesses are different. Ownership combines control, scale, and leverage, but it also removes excuses. A business forces you to face reality, cash flow, costs, systems. The numbers don't care about motivation. That's why. Entrepreneurship isn't for everyone, and that's okay, but understanding how businesses work is for everyone. Because your money will interact with them, whether you own them or not. Now let's talk about fear. Fear keeps people broke longer than lack of money ever could. Fear of losing, fear of looking stupid, fear of starting, and fear is expensive. People say, I'll invest when I have more money. That day rarely comes, because income doesn't fix behavior. If you don't invest $100, you won't invest $10,000. That's why systems beat motivation. Automation removes emotion. The best investors aren't smarter. They're more consistent. Diversification protects you from what you don't know. Concentration can build wealth or destroy it. Most people don't need home runs. They need steady momentum. Here's the mindset shift. Poor thinking focuses on income. Wealthy thinking focuses on assets. Income stops when you stop working. Assets keep working. When you don't, your job is fuel. Assets are the engine. Money amplifies who you already are. Discipline creates options. Recklessness accelerates damage. No one is coming to save you financially. Not your job, not the government, not the market. That responsibility feels heavy until you realize it's also power. Money isn't good or evil. It's a mirror. Learn the rules, and money becomes a tool.